So here,
recording in progress.
Okay, I would like to discuss with you how valuation works. So I have handout number 7. So valuation of bonds. So there are things that you can read by yourself. For some aspects, I will go quite quickly, while for some others, I will go slowly. So here, I start with a zero coupon bond, the valuation. What is it? A zero coupon bond is a bond that does not give any coupon during the whole life of the assets of the bond. Okay.
So we haven't seen a screen.
Ah, sorry. Thank you. That's true. I forgot to share. Do you see my screen?
Yes.
Yes.
So thank you. So I am on I am on slide number 7, handout 7. So a zero coupon bond, what is it? It's a coupon that does not pay any coupon during the whole life of the asset. You receive the whole money at the end. Let's assume you have a face value of 1,000. What is today the value? So if you receive, in my example, okay, 1,000, if the expected rate of return is 5%, okay, and the maturity is 10 years. So today, the value today is 1,000 discounted over 10 years at a rate of 5%, giving the value of 630. This is the way you value a zero coupon bond. You receive the whole money at the end. What's the value today is when you discount this amount over 10 years. This is an example. You have very often level coupon bond. Is always the same thing. We already discussed for perpetuities, if you remember. Okay, so for level coupon bond, you value it like an annuity. Okay, and you will receive a coupon for a given number of years, and at the end you receive everything. Let's take an example. Okay, you have. Let's assume it was yesterday. Let's assume a face value of 100 and the coupon offered is 6.5%. Final maturity is 2027. So it means that you will receive 6.5 each year till 2027, and you get the reimbursement 100 at the last year. So the last year you receive the 6.5, the coupon, plus the reimbursement of the 100. Okay. How do you value this? You discount all the amounts. Okay. So this amount over a year, this amount over 2 years, this one 3 years, 4 years, 5 years. Okay. It's like an annuity. In fact. Okay. You value it like an annuity. Okay. And when you value it like an annuity, okay, if the rate is now 5%, because suddenly after the issue, let's assume the discount rate, the expected rate of return has decreased. So if the rate has decreased, it means that the price increases. Okay, so it's the way we value it. Okay, so the price is the coupon that you receive during 5 years. So it's with the annuity factor, 5 years at a rate of 5%. So this is, oops, right, I will write it. Okay, so what is it? This is the annuity factor. And the annuity factor, what is it? Is 1 divided by R minus 1 plus R exponent. This is the annuity factor. We discussed already what is the annuity factor in the interpretation of the annuity factor when we discussed the annual equivalent cost. Okay, and this is the discount factor. So discount factor T for the rate R, which is 1 over 1 plus R exponent T. Okay. So it's the way we value it. And this we already discussed it. Okay, when the interest rate increases, okay, the value decreases. Okay. There is an inverse relationship between the level of the interest rates and the prices. This is just to show you, this is an example, it's just an example for the zero coupon bonds. Okay, the sensitivity of zero coupon bonds to the interest rate. Okay, so in yellow, it's 15, the maturity of the bond is 15 years. In pink, 10 years. In blue, 5 years. And what do you see? The longer is the maturity, the higher is the sensitivity of the price of the coupon to the level of the interest rate. So for instance, if we move from 1 to 2%, you see the impact here on the yellow one. Will be much higher than the impact on that one. Okay, here you just lose maybe, let's say, 5%, while here it's almost 15% what you lose. Here, just to show you that the bond yields can evolve a lot. Here is the history in Europe during the crisis, the sovereign debt crisis, the crisis from the state debt in Europe. Here, I just pointed out, this is the one from this morning for the 10-year bonds issued by the Vietnamese government. Okay. You could see a few years ago, 3-4 years ago, we were around 4.5%. So now we are at 3.29%. Okay, a month ago, we were still at a rate of 2%. So you see, you have a huge volatility on the rates. So huge volatility on the rates means also huge volatility on the prices. Okay, just as an example. Stock valuation. Alors, what is a stock? Is a share. Okay. So stock, share, equity is the same. Okay. Usually it represents the ownership in a company. It represents a claim on the part of the corporation's assets and earnings. It gives dividends and voting rights. You might have different types of shares, stocks. You can have the common stocks or preferred stocks where you can get a dividend on a more regular basis than the common stock. Stock may be issued or bought back, and they may be listed or not. Okay, if you have a small company with shares, a small company, you are not listed on the stock exchange, but if you are Coca-Cola or Google or Apple, you are listed and all the shares are traded. You can buy them under some conditions on the stock market every day, every minute through the stock exchange. Here, that's quite important, how to value this. How to value this? Let's take a coupon. Let's take, a bond. Let's come back to a bond. A bond, okay, a face value 50, coupon 2, 5% over a year. If you have to value is the face value that you will get in a year plus the 4% out of 50, the 2, okay, that you discount over a year at 5%, and you get the price 49. Okay, this is what we did with the bond. Now with a stock, is quite similar, quite, not fully. The mindset is similar, but we have some difficulties, and we will discuss the difficulties and to see how we can overcome them. For a stock, the next dividend is 2, let's assume, and we estimate the price 50. So it looks like exactly the same, the previous problem, the previous one with the bond. However, the next year dividend and next year price are expectations. Okay, so it's more difficult to estimate the dividend of next year and the price. Here, for a bond, they are defined. Okay, when the bond is issued, we know the coupon that we will receive and the amount that we lend and that we have to be reimbursed if everything goes well, of course, if there is no bankruptcy. Here, with a stock, the story is different because the company distributes dividends only if they wish and if they generated profit. Otherwise, they do not distribute anything. So there is a difference, even if the way to value are quite similar, but the way to estimate are quite different. So I would like to explain two things. I will okay. First of all, the price, what I said, the price is the price in 0 today is the next dividend the dividend in 1 plus the price in 1, but I have to discount over a year. Alors, two things that I would like to explain here on this slide. The first thing, this is the expected rate of return. Let's try to find it. The expected rate of return, what is it? So 1 plus R times the price. Okay. Is the dividend plus P1. I can do it exactly the same thing for the bonds. Huh? I do it here for the shares, but the mindset for bonds is the same. So if I want to calculate the expected rate of return, so what is it? Is RP0 is dividend 1 plus P1 minus P0. And to get the expected rate of return, because it's what I want to calculate, is dividend over 1 divided by P0 plus P1 minus P0 over P0. And here is what I would like to insist to understand this formula. What's the meaning of this? The meaning of this is the expected rate of return on an asset, here on a share. It has two components. The first one, which is the dividend yield, the dividend yield, the dividend yield, and here the capital gain if the price has increased in 1 in comparison to 0, or the capital losses. Okay, I can have gains or losses on my capital. Okay, so if I calculate here, my expected return on my share, 10%, can be split into the dividend yield 4%, 4.23%, and the capital gain, 5.77%. Okay. And the sum of the two is, of course, 10%. So the idea is in your expected return of a financial asset, you have for here a share. It has two components, the dividend yield and possibly the capital gain or the capital loss. Okay. The first thing that I wanted to explain you before going to the case. Second thing, I start with this formula. I will take another color. I start with this. But I can split P1 also in two other components. P1 can be my dividend in 2 plus my price in 2. My price in year 1, my price of my share in a year will be my dividend in the second year and the price in the second, at the end of the second year. And I discount it. Okay. But then I need to get my price in 2. So my price in 2, and then after I stop, is my dividend in 3 plus my price in 3 over 1 plus and so on. And then I can, in my equation here, I can replace P1 by dividend 2 plus P2 over 1 plus R. And then I can replace P2 here by dividend 3 plus P3 over 1 plus R and so on. And I can do it like this till the infinity. And so is what I have. In fact, the general formula my price is the discounted value of all the future dividends. Okay. I repeat, the price is in fact the discounted value of all the future dividends. Okay. And this way to estimate the value of equity of a share, here is what we name the dividend discounted model. Okay. The dividend discounted model. Yes, Violetta?
Yes, Professor. But in this case, we're assuming that the rate of return over the year is the same.
Yes, but it's an excellent question and it's a difficult question to answer. In the practice, yes, because on the current information that we have, okay, because we have to value today a share from Coca-Cola, for instance, from today till the infinity. And the rate that we will take, we will assume that given the information that we have, we will assume that the expected rate of return per year is 8%. Yeah. Okay?
Yes, okay.
Now, the problem is forecasting dividends up to the infinity is not an easy task. It's difficult, okay? So for the next year, it's okay. For the next 2 years, maybe, but after, extremely difficult. In practice, how do the financial analysts? In fact, they use a simplified formula, and it's the Gordon-Shapiro growth model. In fact, we assume that the dividends grow at a constant rate. We assume this. I will explain. We assume we want to value the price today. So we estimate the next dividend. So this usually it's quite easy. So we discount it over a year. Then we have to discount the next dividend. We have to estimate, in fact, the dividends till the infinity. Of course, that's not possible. So we have to find a way to do it. We have to find a way to simplify our life. So then we will assume that the dividend 1, but the dividend 2 will be the same as dividend 1. With a growth. And then we multiply it by, or we discount it, sorry, we discount it over then 2 years because this is my dividend in 2. So in fact, my dividend 2 is the same as dividend 1 multiplied by 1 plus the growth rate. Then I have to calculate my dividend in year 3. It will be the dividend 2. Okay. And I apply a growth rate the same, so then it is squared. And then I discount it over 3 years. Okay. And so this is the dividend. Okay, and I can go like this till the infinite. This is what we name a perpetuity with a constant growth. A perpetuity with a constant growth. And we will see that it will be very useful when we will analyze our case to drink or not to drink. And so we can prove, it's a geometric series, we can prove that this is the price in 0 is the next dividend over the discount rate minus the growth rate. So you see the formula is really simple. And I will explain it and we will apply it. And we will see that there are plenty of applications of this formula. One thing that you should be aware before that we go on. This, I don't know, where is my pen? I lose always my pen here. Yes, here. It works if the growth rate is below the discount rate. Otherwise, the formula doesn't work. Why? Let's think a minute for yourself. So first, let's apply it. Let's apply it. If my dividend, my next dividend is 10, let's put it here. 10. The discount rate, let's assume 10%, expected rate of return. The growth rate, 5%. So we expect a growth of 5% of the dividend each year. So my price will be 10 divided by 5%, meaning 200. Let's assume no growth. So this is with growth. With no growth, so without growth, so let's assume the same company but without growth. Okay, so it would be a perpetuity. Without growth, the price would be 100. Yeah? 10 divided by 10% is 100. So the value of my growth here is 100. Is the 200 minus the 100. Well, the question is what I told you, why we need this condition. Oh, sorry. I don't see my screen anymore. Bon. why do we need this condition? Why do I need this condition? Because, in fact, if you remember, each dividend is the same as the previous one, multiply each dividend is the same as, I'm sorry, I have to with my pointer. So I will try to do it another way. So each dividend is the same as the previous one, multiply by 1 plus the growth rate divided by 1 plus R. Okay. So in fact, my dividend of a year is the same as the dividend of the previous year multiplied by this. Okay. So if G is higher than the rate, it means that this factor is higher than 1. So it means that when my growth rate is higher than the rate, the price tends to the infinity. So it doesn't work anymore. Okay, because each year I multiply the previous dividend by something higher than 1 till the infinity. And so I will get an infinite price, which is not possible. So in fact, if this condition is not met, you cannot use the formula. Here there is an example. And then we will discuss the company valuation. Alors, I prepared for you an Excel file just to understand. There are several things, and you can use by yourself after. But just that you understand. Here you have is the file that you have on Claroline. Okay. I will comment it. You have the payment of the next year, the payment of the, if a share, it's a dividend. If it's a real estate, is a rent. Okay, so it can be for many assets that you value with perpetuities. So for instance, you have 6. Okay, so let's assume you have no growth at this stage. No growth. Okay, so you have the value of your perpetuity is 60, is 6 divided by 10%. And you see, if I have to split the price, the present value of all your payments between year 1 and year 10 is 37. 11 to 50, 23. Okay, so you see that the whole value in terms of discounted value, you get it over 50 years. You see, between year 101 and infinity, when you discount it, is 0. Because, of course, an amount that you will receive in 100 years, when you take the present value, it's nothing. Okay. Now, if I take the growth, 4%, this is the value. Okay. You see, my first payment is 6. The payment next year is 6 plus 4%. After the next dividend, if it's a share, it will be 6.2 plus 4%, and so on. Okay. You have the discount factor, the present value, and then the asset price. Okay. I strongly recommend you to try to understand this table, to understand the way to value. And when we look at the perpetuity price, 100, you see, you can view it in 2 ways. The value without the growth is 460, is what we have just calculated before. The price now is 100, so the value of the growth is 40. If I split the price according to the periods, okay, the present value between year 1 and year 10, it's 43. So it's the discounted value is the sum of all the present value till year 10. Okay. The present value of the payment between year 11 to 50, it's 51. Between 51 and 106, and you see, once again, everything that you will receive after year 100 does not have a value today, or a very, very, very small value. Okay. Try to understand this. Or you can also view it in another way, and you will see it will be exactly the same price that you will get. Let's suppose that you intend to sell the asset after year 10. So in fact, you have the value, the present value between year 1 to 10. You sum all the present values of the payments that you will receive between year 1 and 10, 43, and the terminal value. And what is the terminal value? Is all the payments that you will receive from year 10, from year 11, sorry, here, from year 11 till the infinity. So it's a perpetuity from year 11. And then you have to discount it back over 10 years, and then you get the terminal value 57, and then the price today still it remains the same. Okay. So in fact, this is an illustration to show you how growth perpetuities or perpetuities are used in real life. And for instance, typically, this is the way we can value a share, or we can value also, for instance, a real estate. You buy for your investment, you get a rent, and the rent increases of 4% each year. What is the value? But you value like a perpetuity. Okay, because normally you can expect rents till the infinity. But you can tell me, yes, but you know, I want to keep my real estate for 10 years. I want to sell it after 10 years. You value like this, and then you will get exactly the same price. Okay. be aware when you take, let's think about rents, either you take the real rents, so without inflation, and you take the real rate and you discounted the real rate, or you take the nominal rent with the inflation and you have to take into account with the nominal rate. Okay? So this is a way to value growing perpetuities. Now you can tell me, yes, two things. Here it's not completely crazy to do it like this. Why? Because investors like to have a stability in the dividend payments. They don't look so much at, because you have all kinds of companies. You have companies distributing no dividends, there are some companies distributing dividends, and so on. So for investors, it's not so much the level of the dividends which is important, but it's the stability over the life. Okay, so that's why it's not a bad idea to take constant growth over the years, because usually, and according to academic research, companies tend to have a stable dividend policy. But now you can tell me, hey, Prof, I know that some companies do not distribute dividends. And that's true. And that's true. How to do it? Now then we do not use, here it's the DDM, what we did. And then what we will do is the dividend cash flow model, the dividend cash flow, the discounted cash flow model, the discounted cash flows. And you will see the mindset is quite simple to some extent. You remember? You have your company. You can view it in another way. And your company generate cash flows, free cash flows. You remember the free cash flows? What does it consist of? Is the amount of money that the company can generate out of the sources of funds. Okay? Or it's the money that I am able to generate from the uses of my sources. Is the cash flow from operations plus investments. So, and then what I do, you calculate the value. The value, what is it? Is the discounted free cash flows. So you look at all your free cash flows, you estimate all your free cash flows over the life of your company. Till T1, sorry. So from T1 till the infinity. This is the value today. Free cash flow T. But you have to discount it, of course. Okay. But if we assume, we can assume that if we are in a constant growing perpetuity, like in the case, if constant growing perpetuity, constant growing perpetuity, okay. Then my value is my free cash flow R minus the growth rate. So I use the, oops, sorry. I use my growing perpetuity formula to calculate the value. And then then I have the value here. And here on that side, I have equity plus debt. Then my value is equity plus debt. What I have on one side is the value of what I have on the other side. Okay. So then the value of equity is the value of my company, what my company will generate minus the value of the debt. Okay? Okay. So now let's apply it with my case. Okay, with the to drink or not to drink case. So let's move on. Yes. Wait. Maybe I can. Yes.
Me about the formula. So could you please turn back the value? So I just have a small question about your final formula for the value of the company. So what you mean the value of the company is the same with equity plus debt, right? That's
yes.
the formula. Yes, that's right.
Yes.
That's always right.
Yes. Yes, because what you have on one side is what you have on the other side. Everything that I generate, let's assume you have a restaurant. Okay, you open a restaurant. Why not? Okay, and your restaurant, it works very well. And you developed this restaurant. Very nice food and so on, good atmosphere, very well located and so on. And in fact, and then it's very well developed, and you decide to sell it because you want to undertake another project. How you will value the project? You will value it based on the market value, and the market value is what is all the expectation that the investors could get out of it. Okay, and so and they will pay something for it, but they will pay for the whole value minus the debt, because the debt has to be reimbursed. It does not belong to the people who buy it, who buy the shares. Okay, so if I take the example of the restaurant, this is the value, you estimate the value of your business, okay, and you find investors. If there is no debt, if the debt is zero, you can negotiate on this price, on this value. But if you have debt, okay, a part of the value has to go to the debt holders. So the equity, the shareholders will buy not the whole value, but the value minus what will go to the debt holders. Okay, so for instance, wait. So if the value is 100, if there is no debt, okay, but then you can sell it at 100, and then after there is a negotiation between the two parties, between the seller and the buyers. But now, if the debt is 60, the value is 100, but the investors will say, okay, well, but if, yes, it's 100, but I have to pay back 60. So for me, it remains only 40. So then I am ready to buy for 40. Okay?
Yes. Interestingly, the barbecue, the value of G is not always barbecue.
Sorry?
The growth rate.
Yes, the growth
Yes.
rate, you have to estimate it, okay?
Estimate.
Yes. And it's very difficult, but true. For a restaurant where you have a limited number of seats and so on, your growth will be most probably zero, because let's assume you have 50 seats. Okay, you cannot grow, okay, constantly. Okay, but now if you are in a restaurant and you intend to open, I don't know, one new restaurant each year, for instance, like Starbucks, I don't know, all these big brands, then of course you have a growth. Okay. So now I would like to discuss with you the case study. Now I will share my screen and I will explain you the way to value and what happened in the case, because it's a real case. So I share the screen. Do you see my Excel file?
Yes.
Yes, sir.
Yes, great. So you have the data here. So it's the file that I uploaded this afternoon for you. Okay, you have the file.
Yes.
You okay?
Yes.
So in fact, what I did, I calculated the free cash flows. I calculated the free cash flows, so the operating cash flows, you see, is the first thing that I calculated, the free cash flows. We put it here, this column. Now, how did I calculate it? Is the net income minus the variation of the working capital requirement plus the depreciation. Okay? And I got the operating cash flows. And then I calculated the investment cash flows. If you remember, we already did it. Okay. Is the variation of the fixed asset plus the depreciation. You remember, we did it with the Cinepolis case. Okay, I told you, please do try to make some exercises on the cash flow statement. You have some of them on Caroline. Okay, so the cash flows, the investment cash flows consist of the variation of the fixed asset plus the depreciation. And then I have my free cash flows. My free cash flow, which is the operating cash flows plus the investment cash flow. However, after it's a matter of negotiation, it's a matter of estimation, it's a matter of common sense, you can say, oh, when I look at the income statement, no, sorry, and the income statement, I have extraordinary items. No, it's not what I want to do. Undo, and is what I wanted to do here. Let's take in gray. Okay. And then the question is, should I take these extraordinary items to forecast my free cash flows? By definition, extraordinary items are difficult to estimate because it's normally it should not be part of the core business and they are non-recurrent. So then I can say, I will not take them into account, so I subtract them. Is what I name the cash flows corrected when I do not take into account the extraordinary items. Here I have some students telling me, yes, but sir, look, apparently they are quite recurrent because you have always some of them. I would take them into account. I can understand this, yes. Okay. Me, I prefer not to take them into account, and normally is what we do in finance, because normally, by definition, we cannot estimate them. Well, and then I end with a cash flow from my core business. 100,000. Okay. And I have my debt, my cash flow from the financing, my variation of cash. So I have my cash flow statement you can check. And then I have to value. And then I suppose I have to start with something. I suppose that this one, this free cash flow, is the one that I can get in a perpetuity. Okay. And what was mentioned in the case, I have it here, I think. It was mentioned that we expect yes, sorry. Okay. Let's start with a zero growth rate. Okay. Zero growth rate. And what is the value of the equity? It's a perpetuity. It's a perpetuity. So 100,000 divided by 10%. If you assume that you receive 100,000 of free cash flow each year, it's about 1 million. Okay, you have a debt. However, you have a cash amount when you look in the company. You have this cash amount. In fact, the value that you calculate, the free cash flows, is without taking into account the cash amount. So in fact, the value of your company, the value of your company is the value of the perpetuity, so 100,000 divided by 10%, plus the value of the cash. So this is the value, which is the free cash flows divided by R, minus the growth rate, if there is a growth rate. Plus the cash that you have to take into account. And the value of equity, this is the equity is the value minus the 1.4. 1.4 million is the price estimated. Okay. Is the price estimated. And then now it's the price that you have in mind, you as a buyer. In fact, here we are in the buyer situation, and the buyer, and in fact, it's a real case, and I advise the buyer. And I said, okay, well, 1.4. But maybe you see here, I will put in green like this. Maybe the seller can say, okay, well, you know, but we can expect a growth rate of 2% and all this kind of stuff. And then you can negotiate maybe to say, okay, well, maybe, well, okay, 10%, and then the price then jumped to 1.6 million. Okay, you see, but after is according to the assumptions of the buyer and the seller. Now, the next question was, okay, you can, let's assume that you can increase the free cash flow because you are the buyer. Okay, in fact, they wanted to buy this brewery, and they said, because we can save a lot of costs in administration, for the administration, and we can also improve the working capital requirement because we manage better the inventories, and also we manage much better the collection period of the clients and so on. This can move from 100,000 to 300,000 multiplied by 3. It was you remember? It's in the case. So if you multiply by 3, you see that the value can jump to 4 million. Right? And so this is, in fact, the expected price, the expected value for the buyer is 4.1 million. Because he thinks he can improve the free cash flow. My question is, should he pay? Do you think that the buyer should pay this price? Of course not, because you will not pay what you will do for yourself. You have to pay what the seller has in mind. And the seller has in mind not 300,000, because it's not his will, is not his competency of improving the free cash flows. Here, he has a free cash flow of 100,000. So you will not price, okay? You will not price for him what you can improve, of course. Okay? So you should remain at this price, okay, around 1.6, or if you suppose no growth, it's 1.4. So you should be between 1.4 and 1.6 million. Okay, but certainly not the 4.1. Your NPV, what is it? Is what you will be able to generate, the 4.1 minus the 1.6 if you pay 1.6. Okay, but you certainly not price the improvement. It's like if you buy a house, okay, and you intend to make plenty of renovations in the house, you will not pay the renovation to the seller of the house. Okay, you will increase the value thanks to the renovation, but you will not pay this to the seller. You will just pay the real estate like it is now. You see what I mean? It's exactly the same. Okay? So, and what was the story? What was the story? But in fact, let's imagine the seller was advised by an accountant, and it was said, okay, you take the equity in the book value and you add something for the goodwill. which is completely wrong. Why it is completely wrong? Because it does not take into account the economic value. Here, by chance, is more or less the same. But generally speaking, is not the same at all. The book value is based on the amount of money put by the shareholders during the life of the company plus the accumulated profits. While the market value, the value that you are willing to pay, depends on the future perspectives. It's two different views. Okay. And so here, the seller, based on this, had in mind 1.5 approximately million because of the equity value here, plus some goodwill, some additional value, just because we have some clientele and so on. But I think it's not a good way to do it. You have to understand where does the value come from, and it comes from your ability to generate future cash flows. And for this case, the buyer did a very good deal. Why? Because they paid 1.5. Okay. While the value they could generate was 4.1, so with a very nice NPV. Okay. So, in fact, if the buyer wanted, the seller wanted to negotiate, they could negotiate something like this, and they could sell it at something like 1.6, 1.7 million. Huh? But because they were on a wrong basis, they underestimate the value of their business. Okay, by 200,000, so which is quite a huge amount. Okay, so once again, it's just a way to value a company. I think this is a very nice summary for a class discussion. I will not discuss here. I will not discuss the debt, the financing, the way to finance, because of lack of time, and I think it's quite enough at this stage. I will not do this. What I suggest, and this I will not do it. What I suggest, so if you have some questions, I will take some questions. The course stops here. Okay? But as you know, on a regular basis, I will be in Saigon. And what I will do for the people who are interested to move forward with the financing and the market risk, I will do 2 conferences when I will be in Saigon. So it's out of the exam. It's for the people who are interested to move forward. You understand what I mean? So the class, the topic for the exam, the topic for the class stops here. Okay, I think it's already a lot. Okay, now for when I will be in Saigon, if you are interested, I can do an additional session on the financing and the impact of financing if you are interested. Let's do like this.
Yeah.
Okay. One thing that I would like to tell you, just to comment on what you did, because I think it's important. So for the people who did the things, I would like just to give some comments. Be aware the book value of the assets. I don't know, it's not that one, it's not that 5. So be aware the book value of the assets. You cannot take this for two reasons. The first reason is first of all, book value is not the market value. And in the total assets, do not forget you have a debt. Even if the book value would be the market value, you should subtract the debt. Okay, so you cannot do this for two reasons. First reason, you do not take the book value, you take the market value. And secondly, you have to subtract the debt. Alors, some groups went for the discounted cash flow over a limited period of time, over 7 years. I understand, because I asked a question for the next 7 years with a debt and so on. But in fact, when you value something, you have to take into account all the future free cash flows. So till the infinity, that's why we need the perpetuity. We need to value this. Now, either you take the 7 years and you take a terminal value. What is the value in 7 years? Okay. So which is the discounted value of all the cash flows after year 7, or you take upfront directly a constant growing perpetuity, but you cannot just take over 7 years. Okay, so be aware. And one group, it was quite interesting, looked at the price earning ratios. What is it, the price earning ratios? Price earning ratio, what is it? Is the price per share divided by the earnings per share. So then it's the price divided by the earnings. Okay. And what they did, that's really interesting, but I will criticize after. They said, okay, very interesting. Yeah? They said, and it's commonly done. It's done in reality. Yeah? Sometimes they say, okay, the price or the earnings, let's assume it's 20, for instance, because they look for this industry. So it means for €1 of earnings, you are willing to pay 20. Okay. And they said, okay, the price then, the price then, no, sorry, not the price. The equity. So the equity then, no, sorry, it's so difficult. Excuse me. What I am looking for, the price earnings. Yes, earnings. The earnings here, it's the net income, in fact, earnings. Earnings. Okay. To avoid any confusion with equity. Okay, so the price of equity, okay, is 20 times the earnings. Now this can be okay for a double check if you want. Okay. It can be okay for a double check, but we have really to be aware about this, because the price and the earnings. So first of all, the ratio here will depend on the growing perpetuities. Okay, this 20 can be 10 or can be 25 according to what are the expectations in terms of growth for the company, yeah? Because the price earnings is how much you're willing to pay per euro of or dollar of earnings or net income of the company. Okay, so then it depends on the growing perspectives. To what extent they were taken into account or not. Maybe the average for the sector is 20 because it's a sector with a huge growth. But if your company has no intent to grow, why to take such a huge ratio? This is the first pitfall. And the second pitfall is about the earnings. Okay, the way you calculate the earnings, because it depends on the way you account for and the accounting policies of your company. Okay, so we have really to be aware about this, even if it's currently used, but use it for a double check, for a triple check, but certainly not for a rigorous, I would say, a rigorous estimation. Okay. This is something that I wanted to tell. Okay, so I think I commented everything here. Okay. Yes, I have a question from.
Yes,
yes,
I have. Yeah, I had two questions based on the case we have just showed that because based on the data we have the extraordinary item. So it means that when the data have it, we need to add it into the cash flow statement. And if we do not have, so it means that we will ignore it and we will calculate the operating cash flow like normal.
Yes, you should subtract, not add. Because when you calculate your operating cash flows, you take in, let's assume you have extraordinary revenues. Okay, so in your operating cash flows, these are included. But normally they are not recurrent in the future. Then to have a good view from your operations, your core operations, you have to subtract the extraordinary revenues.
Yeah,
and if it's extraordinary expenses, it's the opposite.
Yeah, I see. I have one more question is that because I also calculate, but the problem is that I see that based on the different calculator we have, for example, you have the number 59,000. Sorry, I need to open it again. For example, 59,617. However, so when I count it, it will be like 59,618. Is it all right if in the test we calculate a little bit error like that?
I am sorry, I do not understand your question. I don't see. Can you repeat it?
Yes, because when I calculate, for example, your result will be the number 59,617.
Wait. For the case to drink, you mean?
Yeah, exactly.
And which amount you are speaking about?
Yes, that is financing cash flow.
Financing cash flow, yes.
Yes. No, I just want to mention that the calculator, maybe it will make a little bit different, like 1 unit, you know. 59,
okay.
yeah. Is this all right for the test?
Of course.
Yeah.
And for the test, you will have, yes, of course. No, do not hesitate to round the figures. Yes, of course.
Yeah, thank you so much, Professor.
Yeah, you're welcome. Yes, Violetta?
So I also have a small question. With some of the formula is quite complicated to calculate on the calculator, and usually we use Excel. So
okay, normally in the exam, and you will see in the previous exams, look at the previous exams. All the problems can be solved with a calculator. the exam is done in such a way that you can solve your exam with a calculator. Do not forget on your calculator to have a calculator with exponents. Huh? Because sometimes I have students saying, okay, well, you know, prof, I do not have exponents on my calculator. Yes, but okay, well, it's half the course with exponents. So I cannot help you there. Okay, but for instance, you know, in the formula with the annuity, for instance, to find the rate, it's extremely difficult to do it handwritten. So of course, you will not have this. The problem will be asked in such a way that you can calculate by yourself. But for instance, to calculate the present value based on the annuity formula, this has to be, you should be able to do it. You understand what I mean?
Yes, I think so.
But for sure, the difficulty to calculate, to find the effective rate based on the annuity formula, handwritten, I would say, it's without Excel is extremely difficult. So for sure, this, you will not have problems in such a way. Once again, the questions will be written in such a way that a calculator, you can solve everything straightforward. Okay?
Yes, I see. Thank you, Prof.
You're welcome. Everything's clear? More or less?
Not on.
Sorry?
Not on, not everything. Yes.
Not everything, but it will be. It will
Yes,
be.
yes. I have to see you in person. How to care to continue to learn more about financial.
Yeah.
Yes.
Okay. So
What should we do in case we all the theory we study here, but we cannot share, we cannot solve on the rigorous exam?
can you repeat? Sorry.
What we learn here, but in case we cannot solve the exam test, what should we do?
But there is the exam test, there is the first one, and if unfortunately it doesn't work, you have a receipt exam.
Yes. How can you help us?
But you have, in fact, you have on Caroline, first you have to learn to read, and you have plenty of exercises with the solutions. Okay, and so try to do them. And also, I think for this kind of course, it's always good to mature, to take time, and also to do some exercises sometimes in group with your friends in the program.
Yes, thank you for this. Actually, I try to digest every day with 35 or 45 minutes per day to try to digest small piece by piece because you know that it's not easy to digest on as one.
No, I know. That's not so easy.
Okay, thank you anyway.
You're welcome. Okay, but please have in mind that I know that's difficult. I know there are a lot of things, but have in mind that the students in the past, okay, succeeded. Okay.
Yes.
Sometimes with some pain, but at the end they succeeded. Is what you have to. And so why not you?
Yes.
Or for sure.
Yes. Yes.
Can I ask how many questions we are going to have for the exam?
Really, what I suggest you then is to look at the previous exams. It will be in a similar format.
Similar. Okay.
Usually, what do you have? You have first questions with a cash flow statement. Then you have some questions on discounting, annuities, perpetuities. And then you have a third part with conceptual questions. Do you think that the liquidity ratio measures liquidity, for instance? Do you think that Do you think that the internal rate of return is a good criteria to decide between two projects? Do you think when the cash flow from when the free cash flow is positive, do you think it's always a good news? You have things like that.
Giấy bà mua nó mỏng hơn giấy bà công ty bà mua ta. Nó giống nhau này.
Yes.
Okay, thank you.
So then you have usually three parts, and then you have the part from Shogi.
You see, I try to copy on the paper here.
Yeah.
Try to write out on the paper. It's very small characters.
Yes, but the idea, you have to really look at the previous exams, please, and also the solutions provided.
Yes.
And first, also honestly, first try to do the exercises without looking at the solutions.
Could we have more exercise for practicing?
But you have already plenty of them, huh? I think. I have to check, but I think you have already plenty of them, huh?
Yes, we have it. We have.
You have really you have. I will check, huh? But I think you have already. Also.
Yes.
In the Higgins book. What you should know that you have at the end of each chapter, you have some exercises. And for some of them, I think it's for odd numbers exercises, you have the solutions at the end of the book. So for 1 out of 2 exercises in the book, you have the solutions. So then it's also additional ones that can be. Okay. So I hope that you learn something. And I wish you a good job, a good studying time. And yeah, best wishes for your work.
How can we become the CFO after this course, MBA?
CFO, it's not enough. Because CFO, you know, you need more finance courses.
Yes.
Okay. These are introductions, but it's a first big jump. Okay. After it depends on what company, but the idea you would need at least another course, an advanced corporate finance course.
Okay.
I think the idea at this stage, what is it, is to give you all the tools in such a way that you can discuss with anybody in the company and then the CFO about the financial valuations. Okay, that's the idea. When you have a project, that you are able to discuss what is behind the project, what is the value of the project, and also in terms of financial diagnosis and financial planning. That's really the idea.
At least we know the BAT.
Sorry?
At least now we know the BAT to become a CFO in the future.
Yes, the WAC. But this is another story, the WAC. But yeah. I can explain it to you if you are interested on a conference mode next time when I will be in Saipan, if you want.
Okay, thank you so much, Professor.
You're welcome. Bye-bye.
Good night.
Bye-bye. Bye.
Bye-bye. Bye-bye, Professor.
Bye.
Recording stopped.
Bye-bye, Professor.
Professor.